But we've got a great topic today. So welcome everyone to our webinar tonight, Winning the Deal in a Competitive Washington Marketplace. Nancy Spiro is here and Grace Lim with Movement Mortgage. My name is Rachelle Wilhite. You guys know who I am. We're going to have a very interesting conversation about the marketplace and some strategies around the forms. Specifically, Grace has been, I guess, dealt a hand to handle the chat. So if you guys, we're going to have a very, we have a lot of content to cover, but if you have questions or you want to pose a comment, please, we'll monitor the chat and Grace will be handling that for us today. Nancy, do you want to give just a little intro?
Sure. We're really excited to be here today as your Movement Mortgage preferred lender. Just helping you understand how you can help your clients win in the marketplace. We've experienced a competitive marketplace, for the last couple of years, and looking ahead on the horizon with a decrease in interest rates, the wave's coming. And so we want to prepare you. We want to add value as your preferred lender. I have been doing home financing and lending for experienced buyers and first-time home buyers, all the way in the gamut. This is my 20th year, so I'm an old veteran here helping you out.
And I've had the pleasure of working with Nancy on a couple deals recently, so I know when she says she can get things done where others cannot. She's a good resource for any of you that have questions about finance. So let's jump right in. Shannon, if you could go to the next slide, that would be great. Or Nancy, you're controlling, I forgot.
I'm doing it. Yeah. Okay. All right. So I'm just going to move this over here. Why is it important to be competitive? So multiple offer scenarios are still happening. We're seeing them. If the property is priced right, you're going up against other people. How do you help get your offer accepted? We're going to come up with some different strategies for that. Again, with lower rates, competition's going to heat up. I don't know if anybody's seen a meme of a jogger running down the street by himself, right, with 7.5% rates. And as the rates drop, next thing you know, he's in the Boston Marathon. So as we see rates decrease, competition is going to continue to heat up. I read a brief article that if rates drop 0.5%, there's going to be over 1 million qualified buyers back on the market. So buckle up. And winning the deal for your client is going to set you apart when they can say, you know what, my realtor got this for us because of they did X, Y, and Z. They're going to tell their friends that because they won and they're in the house of their dreams. And thinking outside the box is key. So, and we all want to be there at the bottom, right? Popping champagne and being excited that our offer got accepted, and then obviously all the way to the closing table. So today we're going to cover some things. Obviously, communication with the client and the lender, to use or to not use the 22A financing addendum. Oops, pardon me. I got happy fingers there. Back real quick. We want to be able to explain the levels of security for your client based on using the different addenda. Discuss appraisal waiver options with the lender. Really, really important to explore those and what that means. Low appraisal addendums, and then some other strategies. So,
and when we're covering some of these things today, I think it's important to note, I've covered a lot of finance related trainings, and our most viewed YouTube training was actually on the 22A when they launched the new form in, I think it was 2019, 2020. It was before everything was crazy. So that's our most watched video of 2023. And so it's very important that we are having a revised, I'd say, training on this topic. So that's one thing I just actually looked up this morning, Nancy. But I'm excited about this. With the upfront conversation with the client, Nancy gets to kind of let me take the reins here and go over this, but I think it's important that you guys, new brokers, people have been in the business a long time, how do you have that conversation? What does that conversation look like with the client when you receive that pre-approval letter or that lender letter? We're going to talk about the differences between those letters, but I think you need to get, if you want to take a picture of this or you want to jot down some of these questions, these are my questions. This is what I do when I start working with a client and I receive their lender letter. I want to engage them, because if I can get ahead of things, once they start writing the offer, it's a lot harder to maybe encourage a double application so that they can save money and time. And obviously I have to know who they're working with and how tied in they are with that particular lender. But my opportunity before I write the offer is to ask them the question, would you consider double application with my preferred lender to save you money and time? This is where I engage Nancy. So I did it with the client that I worked with. Nancy closed a deal with me. Was it October? Nancy, I can't remember when we actually closed. She was a friend of somebody I went to church with, and she had actually already gone into her credit union and applied with her credit union. But, you know, I had this conversation around the time when we did the consultation, and I just said, you know, would you consider double applying? She's like, does that cost me anything more? Nancy, does that cost anything more to double apply?
No, it does
I mean,
not. There's, yeah, you shouldn't have to pay to do a loan application. Some
Okay.
companies charge you upfront for a credit report. We do not.
Okay, see, so that makes it really easy for you to just engage with Nancy or Grace earlier on in the conversation. The other question I asked her is, okay, did the credit union you're working with, did they include the taxes, the insurance, the PMI, and your, and she's just like, whoo, she didn't even know what PMI meant. So that was my opportunity to say, well, let's, you know, get in touch with somebody, our preferred, and have them double up, you know, do a double application. And did the credit union provide you with a detailed estimate? She said no. It was really just on the phone and when she went in to go do a banking transaction. And then, as I have spoken earlier, before I write the deal, I'm going to ask her, will you have the earnest money ready? And are there any other decision makers that are involved with your the ability to make the offer? So those are kind of my questions, my notes that I kind of have internalized over the years. I don't know if you have questions that you do, but yeah, certainly put them in the chat if there are other questions that you ask your client before you write the deal. I'd love to see if there's anything else that you do in your business that may help and inspire somebody else. Candace, specifically, if you have any other questions that you do. But yeah, you want to really engage them and understand their application and their experience with the lender before you write the offer. Let's go to the next slide. And so the other thing you can do when we have this available in our resources, if you want to download this, it is also in our transaction desk. But before I write the offer, and you know you're going into a multiple offer situation, I love this. We've created this back when it was a frenzied competitive market a couple years ago. But buyer's disclosure in a seller's market. It's if you have no contingency or you're thinking you're going to have to waive some contingencies, these are some risks. We made the header look like the kind of the risk, the wire fraud alert. So we kind of had Lori, our marketing director, make the top portion look like attention. And then we kind of go through, and if you're a new broker, you're probably going to want to look at the cash offers and offers above the grade. There's even a place for you to initial. You have the buyer initial. So you can use this effectively in your consultations. And that gives you some comfort knowing that you have properly advised your buyer about the removal or the waiver. I know, Nancy, you were kind of concerned. You're like, oh gosh, you know, am I going to be on the line if they waive, you know, their finance contingency and I'm their preferred lender? Well, my gosh, our agents at Best Choice Realty have definitely used this type of disclosure. So there has been proper advice given when they write contract terms like waiver of financing, which we're going to go into some pretty creative, I would say, scenarios here in a minute. So definitely before you go creative or kind of go off the typical standards of the contract, you want to make sure you've used this disclosure. Let's go to the next slide.
Sure. I just want to say, I think this is great. I think having them acknowledge it, because when they're doing it, right, these are their lifelines to save their earnest money. So having them acknowledge it, seeing this form, this is fantastic. I would love for all of my clients to review this and just put a little initial on there, you know, so it's very good.
So upfront conversation with the lender, and we could almost role play this, Nancy. So, I mean, if I had a client, right, and I'm calling you to kind of make sure, we're going to write the deal. I'm going to call you and say, Nancy, I've got April, she's going to be buying a house. She's going to be buying a house on, XYZ street. So I want to make sure that that that's the property and you confirmed. Condos are tricky because sometimes the condo units or, the addresses don't match up. So this is where you definitely want to confirm. I'm working with April Manson, and she's going to be buying XYZ property. Is that the client you're working with, Nancy? And then you confirm that, right? And then I'm looking up on the MLS and I'm saying that, it's this address and the taxes are 4,800. And I just want to confirm, are we doing, and there is an HOA of $200 per year. And that would be amazing if it was $200 a year. It never is. But I'm confirming those details because that impacts, right, the borrowing power, right, that we have. Some of these deals are pretty tough to get through.
100%, 100%. And we want to make sure that you're including all of those, leaving out, if it was $200, most HOAs aren't. One of the things with condos, there's a little bit more scrutiny with them and the reserve studies and things like that. So we might not have all of that information. But before I issue a pre-approval, and I know Grace as well, we just don't take the borrower's word for it because sometimes what they think might not be what it is. And so before I'm going to send a pre-approval, I know Grace is the same. We've actually seen the bank statement where the earnest money and the funds are for the down payment.
Right.
If it is a gift, we've spoken to, parent, grandparent, whatnot. We've reviewed income documentation. We've run it through. And it's so important because there's nothing worse than, sending a pre-approval letter and then, they don't actually qualify for that property. So I always say, make sure you send us the property that you're interested in because property taxes differ on every property. Yeah. So that changes.
Yeah. And I think she's speaking on, and again, Nancy and Grace do a very professional job when they work with the clients, but not all lenders are like that. That's why it's important that if you are working with somebody not with movement, that you are confirming some of those down payment details, because you as the real estate professional have an obligation to make sure that when you're writing a finance contingency that you're confirming that down payment. Otherwise, you could be brought into a legal matter. You could actually have some complications if earnest money is lost. You could potentially have some legal complications as well. So you have a higher duty to confirm those details with the lender to make sure that that's been reviewed and that you're properly stating that on the contract when you're writing that into the contract.
And even just interject with, down payment of funds thing. Sometimes people are accessing retirement accounts or certain investments accounts, and there's time frames when they can take that money out. Sometimes they can only access it quarterly. So really digging in and not just, oh, here's a screenshot. I've got $300,000 in the bank. Well, can you access that? Because that's going to affect your closing time and when you can actually have the money there for down payment and or earnest money.
And I know you and Grace call the listing agent. That's one of your business practices. Not all lenders do in a multiple offer situation, but you definitely want to prepare that lender. I had an interesting thing happen to me, Nancy. I was the listing agent and I got, I was able to, we had 12 offers. I remember this like it was yesterday. And 2 of the lenders actually called me, but the lender actually made me feel as a listing agent uneasy. So you want to have somebody that has a very good way of not sharing too much. Sometimes the lenders they'll call the listing agent and maybe share too much that will make them feel uneasy. And I can attest to the fact that Nancy and Grace do not operate that way. They do share enough to help you win the deal. They're not going to make it appear like your borrower is, less than. I would say they're going to share what they legally can share, but they're not going to detract from the whole goal of getting the win. So, but prepare the lender. If you've never worked with that lender before, make sure that if they are going to call the listing agent, what they can and should not say.
I think there's also just a weight that comes to having a local lender, not having somebody in, Indiana who doesn't know Washington, doesn't know, Microsoft contracted employees or Amazon. and being, Movement has #1 market share. So people have heard of Movement, our reputation precedes us in getting the deals closed on time. So that's helpful as well. And just really knowing your lender too. So.
And so with my client April, Nancy, I mean, I'm going to want to tell you, I'm going to be probably writing it up, and we're going to be involved in a multiple offer situation. So I'm going to want to close definitely less than 30 days. Is that going to be okay? And you're going to have to say, well, based on April's situation, we need to get the underwritten, or we need to get the extra pay stub, right? I mean, there's obviously always something, right, that you're having to collect in order to meet that closing date. If we're going to close in 3 weeks, I'm also going to tell you we're not going to do inspection. We're going to waive the inspection. So there's things like that will obviously, every situation's a little bit different. But in that situation, I know Movement Mortgage can close quick. So, I'm going to discuss the risk tolerance with the borrower, but I'm going to draft it in such a way where we are going to have to be very competitive on our timelines on making sure that it gets closed. And so is that going to be a problem with April, closing in 3 weeks? Is that going to be a problem?
You could say, oh yeah, that's no problem. Well, oh wow, you know what we have? We've got a holiday coming up. You got to factor in and actually look at the calendar and see, we can close in 2 weeks, not the last 2 weeks of the year, because a lot of, we've got holidays. So yeah, we do want to look at that and not just guarantee. Missing a closing date, in my opinion, is the worst thing that could ever happen for everybody involved. It's already a stressful enough situation. And so, yeah, we want to make sure that if we're saying we're closing in 3 weeks, that is doable, and all the factors are in place. So
can I close on January 9th then, Nancy? See, that's what agents will do, because again, we are trying to compete, because January 15th, let's see, that would be a Monday. I kind of want to close the 9th if we can. Is that possible? I mean, that's going to be, I know with the holidays, but is that possible with what we've got?
If you're waiving inspection and we have the completed contract signed today and are able to get disclosures out immediately, and the borrower knows that we need everything updated, and I would have collected everything, yes, we can get that going.
Okay. So you definitely want to have that really upfront conversation about timeline, closing date, and that the borrower understands that earnest money will become non-refundable at whatever time. So yes, I love that we can do things quickly with Movement Mortgage. Okay, let's go to the next slide. So this is our lovely 22A. And so here's what I wanted to cover. I mean, you guys know the finance contingency. The double application falls within term 1. They have the ability to shop in term 1. This is an old version, I believe. Let's see, they have 5 days. No, it's right here on term 12, or line 12. They have 5 days, so you can cut that down. And if you have already made application with Nancy or with Grace, with a preferred lender, and they've collected the stuff that they're talking about, you definitely can go ahead and cut that timeline down from 5 to 1. That is not a problem. It's if the borrower is going to be shopping, maybe they're with, they made application with a credit union, like I gave in that scenario, and they are going to double app with, say, Nancy or Grace, then you would want to go ahead and maybe keep that 5-day default. But if you're structuring the 22A to win, you need to look at options to cut timelines down. So many brokers, buyers agents that win, depending on how the other offers all stack up, the winner usually has cut some of these timelines down. So that's the first guide that I would give you, or tip. But then it's understanding of the form. And Nancy and I were talking, I'm like, she's like, well, I don't know the difference between the 2A and the 2B very well. I mean, she's not the real estate agent, she's having to perform. But the difference between the 2A and the 2B, the 2A and the 2B, it's better for the seller on the 2B. It's better for the buyer on the 2A. I'm going to say that one more time. So if you're in a competitive situation, you're probably going to want to advise that automatic waiver of financing contingency is used rather than the 2A, because it's better for the seller. And if you're in a competitive situation, it's having to, if you had selected 2A, which is better for the buyer, you would actually, the seller would have to give a notice and they'd have to wait. And then the contingency lasts the life of the escrow, meaning it continues on even after that period if it is not waived with a notice. So it makes it trickier and the buyer has more rights when you use 2A. In contrast, 2B, once we get past, and this is the way I would do it in this scenario with April, I would probably make my automatic waiver of finance contingency. I'd ask Nancy, how quickly can we get the appraiser out there, Nancy, on April's deal? How long is it taking right now?
Appraisals are really quick, so we can
Like
get the appraisal order.
Can we get the appraisal order in a week? Great. So
Absolutely.
I'm going to make my financing contingency. I'm going to cut my timelines down. My closing date's going to be about 3 weeks. I'm going to cut my B down. So 22A term 2B, I'm going to cut that down to probably 10 or 15 days so that we only have enough coverage. Obviously the bank, the bank statements are good. She's collected documentations. We're pretty close. We definitely need an appraisal, but we want to have coverage and we want that financing contingency to be lifted or gone. Earnest money would become non-refundable after, if I put 15 days, on day 16, that earnest money would be going to the seller if they were not able to close on the deal. Okay, so it's just really a firm date. It doesn't mean if you check 2B that it's, I think a lot of new agents think, but it says automatic waiver of finance. They automatically think, oh, it's the waiver. It is not the waiver section. It just is an easier paragraph to include so that the seller knows officially the earnest money will become non-refundable after that period of time. Most states, other states have that type of language written into their finance contingency. In Washington, we continuously operate with a very buyer-centric contract by the default being 2A. So my encouragement to you, if you're in a multiple offer situation, is to discuss with your buyer, maybe we change it up and we get them to agree to a 2B rather than the 2A. Okay, does that make sense, Nancy?
Absolutely. And again, I'm going to sound like a broken record, but you need to make sure that your lender knows their stuff and has really reviewed it, because you don't want to lose your earnest money over that or an oversight on that. And it's just so important. So, yeah, again, broken record, because
okay.
We'll move on.
But that's like the start of it. The next one would be, so this is not used very often in the state of Washington, but I mean, if you're having an upfront conversation with your buyer and they're concerned about risk, about risking their earnest money, and we're going to be in a multiple offer situation, some scenarios, it's like, I'm confident. I work at, Nintendo. I am secure in my job. I've been there 25 years. Rachelle, I'm not concerned about not being able to be qualified by Nancy or Grace at Movement Mortgage. I just want to have comfort and protection only on my appraisal. I want to make sure that price that I'm paying, especially if I'm using an escalation and increasing the price, maybe I'm paying 900,000 and the listing price was 800,000. I just want to make sure that, and my earnest money protected, that I have an appraisal contingency. And if that's the case, maybe I don't use the 22A, but I use the 22AA as the protection clause. Again, you still would work with your lender to make sure that you know how long it's going to take to get the appraiser out there to do the appraisal. But this might be another layer or a different layer of protection, and you don't need the finance contingency. You need an appraisal contingency in that case. I purposely cut off the bottom of the form because I wanted to see if you guys could answer this simple question. I could do a poll, but just go ahead and put it in the chat. What is the default for the appraisal contingency on 22AA? And I'll give you guys a minute to do that. What is the default? And in your multiple offer situation, I guarantee you're going to want to cut that down, but let's see if you guys can get that answer. Go ahead. Some of you have been in the business a long time. Maybe you haven't looked at the 22AA in a long time. I know I have not seen it in a lot of my reviews, but it is a strategy that's used to win.
I love the pop quiz. Come on, everybody. Jump into that chat.
Go ahead, give me a chat. What's the default? Come on, somebody doesn't want bragging rights to win this little pop quiz. I know Shannon knows the answer. Okay, we got one guess. Give me two more guesses. What is the default? John Shepherd, 21 days. Good job. Yes, it is. The default is 21 days. So that's basically takes the entire life in my scenario of April buying a home. 21 days would basically be 3 weeks. So I could write it that way or leave the default in, but in a multiple offer situation, like I've said earlier, probably going to want to cut that timeline down and basically do a different date. So maybe we cut that appraisal contingency down to 15 days or 10 days, but that's what you attempt to do, is negotiate in that fashion. Great job.
And appraisals were taking, 3 weeks back in the time where, we were doing a million deals. But yeah, appraisal turn times are quick right now. The appraisers are ready to accept the offers. We work directly with our AMC that sends the order right out, and then we'll get confirmation, and then it's scheduled, and we communicate that with you as well. So
Awesome.
You can be on top of it.
Okay, let's go to the next slide. So that would be, maybe you use the 22AA. Some advanced, I wouldn't consider this advanced. A lot of intermediate agents have learned in a multiple offer situation, they've learned the 22AD. I have a little note here that on the 22AD, you must use the 22A or the 22AA as well. So you either have to choose, am I going to use the 22A and the 22AD, or I'm using 22AA and 22AD. That becomes a little bit easier to understand when you're trying to fill out these forms. Otherwise, it becomes confusing. If you pull this up and you have no 22A, there's nothing that ties it together. As you can see from term 1, you're using that with the 22A, you don't fill out number 2. And if you're using 22AA, then you're checking the box number 2, you're not checking the box number 1. So you basically have one form that pre-negotiates in the event of a low appraisal. So in my scenario with April, at 900,000 when the listing price was 800, well, if let's say that the appraisal only comes in at 850, not at 900. So basically what we would be negotiating here or pre-negotiating is that April has, if we use the 22A, we check the box number 1, that she has $50,000 of additional funds to come up in the case of a low appraisal. And it has to be verified. So it supersedes the appraisal less than sales price provision in the 22A, and it pre-negotiates and tells the seller, yes, my client has additional funds in the case of a low appraisal. So that gives the seller a lot more comfort in going with, say, my contract over somebody else's contract, because I understand and can pre-negotiate in the event of a low appraisal. The notices also change, so it shortens down the timeline. So in the normal 22A, it gives you like this negotiation period of like 10 days, and then they have to give you 3 days. And this shortens that timeline way down. So it's only 3 days and 3 days, which is very important when you're doing a multiple offer situation. So yeah, using the 22AD is I would say an intermediate form. Agents that have more training are using this to win. But you have to work again very closely with your lender, Nancy. I mean, I'd have to call you and say, does she have 50,000, right? I mean, and you'd have to say, yeah, she does, or I verified her bank statement. And so I know what to fill in on term 1A on the additional funds. So again, just like the down payment on the 22A, I'm responsible working with the lender to properly disclose. Otherwise, I could be breaching the contract and have legal complications as well if I make an error here on the additional funds. I have seen huge errors. I have seen people write $175,000 when they don't have $175,000. So be very careful on what you put here. And if you have questions or you never have used this form 22AD, that's where I'd love to engage you. Like, let's talk about it. Before you send this out into the world of multiple offers, let's make sure that you've got it filled in correctly, and then it's you have a good understanding of how this is done in practice.
And researching your property as well, right? If you're in and you're going way over asking, what are the comparables? Like, do a CMA for your client to know what they might be stepping into.
Good point. Yeah, I don't use the 22 AD unless I've done that work, right? I've actually know what we're going to be going up to. Because a lot of times the listing agents, they put that teaser price out there. I mean, that 800,000 in Kirkland is definitely going up. I can assure you of that. It might even go up to $1 million, right? And so a lot of listing agents will put a teaser price, and then they'll make the buyer's agents do, like you said, Nancy, do the CMA. And do that for them. They'll just basically put the teaser price out there and let the bids begin, and we are going to see that coming up here in January.
Absolutely.
Okay, let's go to the next.
Okay.
So a low appraisal comes in. This is what happens. So Nancy's going to go over this with you.
So we've talked to your client, purchase price was 500,000. They were going to put 10% down. Obviously, easy math there. They're financing 450,000. Appraisal comes in, hits right at the purchase price. We're great. Nothing there. Appraised value comes in at 475. So we're $25,000 less than what we agreed upon. So the appraisal's for the lender's purpose, right? Because we want to make sure we're lending on the collateral. So truthfully, I mean, in the scenarios, the selling, it doesn't matter to them. So our loan is going to be based on either the purchase price or the appraised value, whatever is lower. So in this situation, we can still do the deal for this client, even though the appraisal came in lower, because she's just going to shift her down payment. So she's going to put 5% down, which is going to increase her mortgage insurance. And if we think we might be in a situation where the appraisal might come in less, like I would look at this with my client, say, okay, what if we had to shift and you had to, because you need to absorb the difference. Can you afford it? Do we have room there? So this is great if you have somebody putting 10% or more down. If you have somebody putting minimum payments down, this isn't going to be a strategy for you. So know what your down payment is. Very important. But in this sense, you just saved the deal, even though it's coming in $25,000 less. For some reason, April's still buying the house. April's still getting in there. And you can see the payment really isn't all that much more. It's about $40 more, just because the mortgage insurance increased, because she's a top-notch borrower.
And I guess this would work too, Nancy. Let's say that the client did not want to put the 22 AD in. I mean, let's just kind of go. I mean, you have a nice little scenario here that explains that to a client that, we're going to tell the seller we're serious, we're putting 10% down. But if for some reason we do have to negotiate a low appraisal, which is already spelled out in 22A, 22A already has an appraisal contingency built in. Term 5 talks about that appraisal contingency. But there's like this back and forth negotiation. So maybe we strategize on what we put down and what we disclose and how we disclose it. And this scenario kind of breaks it down for the client, letting them know that there's ways to still keep the deal together. So let's not be so worried about having a full finance contingency. Let's just have an appraisal contingency. Because if you're not concerned about your finances in that way or your job, but you have the funds like this particular scenario, we have some ways to keep it together or to strengthen your offer if we get a counter offer, things like that. Great.
Okay.
Let's go to the next. So another strategy, and I helped a lot in 2017, it was giving me a lot of anxiety, but I had new agents learning this, basically going through this type of training and learning how to communicate better with their lenders, and then essentially not using a finance or an appraisal contingency, but using a evidence of funds and using it like a cash borrower. And this is happening more than you can even imagine right now. So we have a lot of people going into the scene and writing up the deal, not using a 22A, not using a 22AD, not using any AA, 22AA, that's not even happening. We're literally going in and we're going to make our earnest money non-refundable from the very beginning because they're that comfortable and they've been looking for that long with their lender for a property. And so they're writing it with a 22EF and they're not including anything else. But that would mean that they're waiving their finance altogether. They're making their earnest money non-refundable the moment it goes mutual the moment the contract is accepted. So how you do that is you use the 22EF, which is this form here on the left, and you don't check number 2 because you're not a cash borrower. You're checking number 3 and you're indicating the loan. And that's very important you work with your lender to make that very, very clean. You want to make sure that if it's hard money, you put hard money. If it's movement mortgage, 20% down loan, or you can put, the more transparency you give here, the better. If you're going to be putting 40% down, 50% down, that's great. You should share that, because that is going to be different than, say, a hard money lender on the loan. So if it benefits you, put more on there on 3 and then check the loan box. And then the seller shall provide always on line 29. I purposely broke it right there because a lot of you miss it. Definitely, you want to go ahead and fill in. You don't want it 10 days in my scenario with Nancy with the 21-day close. If I had just left the default of 10 days, that means that Nancy would have to get the funds to escrow 10 days before the closing date. So that's going to put her like probably in the next week. Nancy's not going to be able to perform that way. She's going to be really upset with me and like, why did you write it that way? She's probably going to fire me too. So because I didn't understand my contract, and she's going to think I'm not a professional agent. So to prevent that from occurring, you definitely need to read your statement here and end up changing. You can keep that. You definitely want to disclose the funds, because you're attempting to win and disclose that you're going to not have, or you're going to waive finance. But number 3 is going to say, where are those funds coming? It's going to give the seller comfort in knowing that your funds are going to be at escrow. I would suggest putting 1 day prior to closing, so that Nancy knows that I've got a closing date, and the day before closing, I've got to have the funds at escrow. So it does help. She needs to understand that clause and how it's written that way so that she can perform. Because if she does not have the funds at escrow, I have had a buyer lose the deal because there was a backup in place, and they kicked that buyer out and they went with the backup because the funds were not there. The funds were coming from a different country and the funds never arrived. And the sellers were able to immediately terminate the deal because of the section 3 here, and were able to put that backup buyer in place and close the deal. So again, it's that important, but it does get the seller comfort knowing that you're going to provide the evidence of those funds, and it's going to be in the escrow account. And so that's what number 3, and that's why it's so important to use 22EF. If you're going to compete with a cash offer and you're going to waive everything, this is the best strategy I know to win the deal in comparison to a cash-like type of borrower. Okay. So new agents, rookie agents can win.
It really is.
Go ahead, Nancy.
Yeah, I was just gonna, this is your ace in the hole. When I talk to agents and they say, yeah, we want to waive everything, we're going to waive finance, just so you can have this in your memory. This is my look. Just because it's their one saving. So it's up to you. They know their risks involved and all those things. But if you're even going to cross this bridge, they need to be pre-underwritten. They need to go through our underwriting department if you're with us. And I would just implore you, for whatever lender you're working with, because even a pre-approval, things pop up in underwriting. It's inevitable. Variable income, you can got pay stubs. They work 40 hours a week, except 1 week it was 39 hours. You got variable income, it's calculated totally different. And so you don't want to be caught in that kind of situation. We want to make sure, nope, we've had everything reviewed. Oh, there's bank statements. They got to charge every month to, $2,000. Oh, they're paying off a loan to somebody, things like that you really do that before you say, hey, our financing is, in the bag.
It's solid. Yeah. No, that's a good point. I would say that I would be less likely to go with this strategy if I was using somebody from another state. They don't understand the timelines or the contract. They basically are just pushing paper through. And we have run into problems with different programs that you're using. They just don't understand that how important it is to hit the closing date. Okay, let's go to the next slide.
Okay.
So let's review the offer structure. So as you're kind of sitting here going, okay, I'm a new broker. I'm trying to like make sense of all of these. Washington State, love the forms here in Washington, right? You've got 22A and all these forms. So let's just review. 22A term 2A is the most protection of your earnest money. So that's basically, if I'm like thinking through this, like giving me the framework, a lot of new agents have clicked this slide just because they have to kind of have some sort of understanding of how these forms relate to each other. So 22A, term 2A, most protection of the earnest money, and it's like just between not a multiple offer situation, right? It's just a normal way of doing business in Washington. Then we start to get, you still have protection if you go with the 2B, but it's going to have a defined ending time of your contingency. So that would be the next layer. Then you've got the option of not including 22A, but going with 22AA, and that should be pre-underwritten so that you know that the borrower has had their bank statements reviewed, that they, you know, it's a solid deal, and the borrower's not concerned about job loss. I mean, that would be also something that would be protected under the 22A, would not be protected under the 22AA. If you feel like you're going to lose your job in the next 30 to 60 days, I probably wouldn't waive your finance contingency. I probably wouldn't waive that at all. I would go with the 22A. But the 22AA is like, no, I'm solid on my job. I'm solid on my financing. I've already spent time with Nancy and Grace. I'm going to just make sure I have protection for my earnest money with the appraisal. That would be 22AA. Then you go to the next layer or kind of tip. 22AD would be used in conjunction with the 22A or the 22AA, and it's pre-negotiating in case of a low appraisal. It is still protecting the earnest money in that case. So the last one you would use would be not to use anything up above 22A, 22A or B, or all of those. You just go with the no finance contingency or appraisal contingency. It's the least protection of your earnest money, and you only use this with a savvy lender and a properly defined closing date. You definitely want to look at those dates.
I think you could say that 3 times over, like, make sure.
Yes. Yes, but I mean, that's basically the going from the most protection to the least protection. And it really is not your place as an agent. I've gone into a negotiation situation. I've sat down and explained to the buyer, you know, how comfortable are you? Let's put up, you know, earnest money. Let's go 50,000 earnest money in order to nab this, you know, $1 million property. And that's sometimes not even enough. I mean, are you willing to put up 75,000 and write it with the 22A and have a finance contingency? Yeah, I'm comfortable with that, right? I'm protected. But when we start to get to no protection and we have $75,000 on the line, suddenly they start to get a little worried. And then I go back to that disclosure form and we talk about it. And we say, this might be the only shot we have at winning if we are to write it this way. But they have to understand the implications. So you definitely want to go through at least some understanding of the forms, so they know how to write it. And honestly, I've had to go through, and just like you, I had to write and lose. And then they lose and they're like, dang it, I should have done this, or I should have done that. Buyers tend to be a bit more aggressive the more they lose. So if they lose and they're licking their wounds because they lost the house 2 months ago and now another one comes on the market, you almost have to revisit the conversation with them to help them understand why they lost. Well, the last time we wrote the offer, we lost because we had a 22A and we had the most protection of the earnest money. If we go with a 22AD and we show the strength in our financing, we may have a shot. So you may have to write several deals for them to get them comfortable in going with the most, I guess, high risk, high reward, right, Nancy? Sometimes that's what it takes in order for them to win. But it's a process with some buyers, depending on their risk tolerance of how they want to put up their earnest money. It's their money, right? And I'm just the communicator of how they want to display that on the offer.
Like I said, I've been doing this for 20 years, and you know, those first time home buyers, it's a pain point, right? Then they have to, you know, like, okay, we're just going to write on this one. This is going to be a learning experience. They're going to learn what these addendums are. They're going to learn what the process is and what it's like waiting to hear back if your offer is accepted.
Yep.
And so it's part of the process, and just know you'll go through that with your borrowers, especially if they've never bought a house before. And it's your job just to be with them and educate them and coach them as it will be with like your lender as well. So yeah, it's sad, but sometimes you got to go through it.
Yeah, well, that's what experience makes the difference. So those of you that are on the call today, I mean, this is what's nice is you guys are getting the training that will give you the edge up on some of the newer agents. I tend to see a lot of new brokers working with new borrowers and they don't have any understanding and they're losing. And if you looked at all their offers, the reason they're not winning is because they don't know the strategies here that are right here on the screen. They don't know how to communicate that well with their borrowers or with the buyer. And then they lose and lose and lose. And then they finally, sometimes they fire their agent and then they end up going with somebody more experienced who can explain why they lost or how they can structure their offer to win. And sometimes it's just knowing your forms that makes the difference. So that's kind of a nice little review sheet right there. Let's go to the next slide. We've got a couple more slides and then I think we'll have a couple minutes for questions. So Nancy, you have some other resources that you've seen. Why don't you go over some of that?
Yeah, the earnest money non-refundable or release of earnest money, shortening the time frame on that. You know, if we're gonna release the earnest money to the seller within 3 days, you know, that might help you win the deal. Very important. I want to this next bullet point. So there's pre-qualified, there's pre-approved, and they're pre-underwritten. And so pre-qualified is, let's say, you know, Rachelle's my client. She calls me, oh yeah, you know, I just got a raise. I make this much. I've been in my job. My dad's going to give me $25,000. What could I qualify for? Okay, well, here's what you would pre-qualify based upon that. That's not very solid. That's just kind of like, all right, here's sort of an outline. A pre-approval is when we actually have the information. We reviewed your pay stubs, done a verification of employment, seen the funds for the down payment, for the earnest money, and can issue that pre-approval. Not every lender does it. Some of them will let you put your information online and you could spit out a pre-approval. It's important that you really know from whatever lender you're using that that pre-approval is solid and has had those items reviewed upon. And then pre-underwritten, this is the gold standard. And this is where, you know, it actually has gone through the underwriting process. Underwriter has reviewed everything. We have a fully underwritten conditional approval in hand, just waiting on a property to be identified. And so again, if we're going from lowest to highest in terms of quality, you know, pre-underwritten is going to be your top one, and going back to pre-qualified. So though having those resources and knowing what those are for your client is going to help you win. Again, we've talked about this, but a local lender, you know, if you have somebody that's going to take your phone calls and that's going to talk to the seller and provide that pre-approval letter at 7 o'clock on a Sunday night, or if you're working with, you know, XYZ lender in Indiana, they don't know, you know, if they get the appraisal and they see moss on a roof, they're going to freak out. Well, we know everybody's got moss on their roof here in Washington. So local lender that has local underwriters is also key. Cover letter with reference to financial position. I mean, I've seen pictures of the family. I've seen pictures of their sonogram with the baby coming. You know, you can do all the things.
It actually does not what you should be doing in your cover letter is not about that. It should be about their financial position. You can make a determination based on the financials. So if your cover letter has more about, you know, my client has been at his job for 25 years, is in the military and has served our country, those are the types of things that I would definitely put into a cover letter. And we have a beautiful cover letter you can use. So even better, you can use that in Transaction Desk, or you can download a sample cover letter from our resource website as well. So you have two very, very easy places to get that. And then did you talk about the down payment? You talked about.
Yeah, just the proof of the down payment of funds, like actually providing that bank statement to the seller. If you're comfortable with that, you know, as the buyer, but you're actually showing it to them. They're not, of course, they'd want to trust Nancy. There'd be no reason not to, but the proof is actually seeing it. So I've seen that in real competitive situations. They're, you know, giving everything they've given to me, they're giving to them. They're like, here, you want my pay stubs? You want to look at all my stuff? And so that is that is
just make
definitely.
sure you block it out, right? Some of the account numbers, make sure before you scan and you attach, make sure you're blocking stuff out. But as far as the proof, I saw an agent, and it was fairly new agent. It was kind of fun because there was 5 other offers in Tacoma, and 4 of the offers, we won out of the 5th, because we provided proof of the down payment. Everything else, they were all financed. They were all, there was no cash that we were competing with. So it really came down to the strength of how we wrote the offer is the reason why we won. And I think it was because of the proof of the financial position. Definitely had a cover letter and definitely had proof of the down payment. And you're like, well, that's kind of above and beyond. Yeah, it is kind of above and beyond. You're making the decision very easy for that listing agent and that seller in determining out of 5 offers that are all financed and first-time home buyers, which one has the best, the best way of getting to the close. Which one are they most comfortable with? It doesn't come down to much in price. It's all pretty much on the strength of the finance. And so why would you not work with your lender and supply the listing agent with proof of, say, the gift letter, or showing that the gift is already in the escrow or can be in the escrow account within 2 days. I mean, anything like that you can provide to the listing agent will show strength. And you want to showcase that when you're in a multiple offer situation.
100%. And then lastly, we just touch on our 671 lending with movement. So this is what the company was founded on. The 6 is for 6 hours in underwriting. That's the goal. So once we have everything and submit it to our underwriting department, it's underwritten within 6 hours. Is that going to happen every time? No, but that's the goal. So, and then once we get that approval back, because you don't want to wait 5 days for your approval to come back and find out there's a hiccup, right? We want to know upfront right off the bat. And then we have a maximum of 7 days to collect any conditions needed to clear the file and submit it back for a 1-day closing. So that's how we can move quickly if we have to, is because of the processes and the structures we have in place at Movement Mortgage.
Okay, and this is the non-refundable language that is approved by our attorney. So it is available for download in your transaction desk. I did not find it in our downloads in the resource website, but it is in transaction desk. If you do need to use that in a situation of negotiation, you can see it's on a Form 34, but it is approved by our attorney. You may use this. I'd rather see you use this than say, write earnest money is non-refundable in your contract. That is not sufficient. It is not properly approved by an attorney just to state that. It needs to be defined. And I purposely left it out. The paragraph actually goes down even further past line 27. So this is where you'd fill in when, I think Nancy alluded to it earlier, that when is it going to be released as a non-refundable deposit and at what point? So you have 3 options. You can fill in section 1, or when the inspection is removed, or when the financing contingency is removed. If we're going with the 22EF, we would just have the earnest money non-refundable. That would be a tactic that we would do. And you have the ability to fill in the amount. So say I didn't want to make all of my earnest money in my situation of 50,000. Maybe my borrower wasn't okay with the entire 50,000. I could only make 25,000 non-refundable and give that to the seller initially after deposit, and instruct escrow to go ahead and release that. This gives you some options here on this addendum to make those decisions with your client. Again, I've had this language vetted by our attorney, and again, all good to go. But if you're trying to create language on your own, again, you're practicing law and it's not encouraged to do so. So if you're typing something into a 22D, or I've always done that, I would highly discourage you away from doing that, and instead using this type of Form 34 non-refundable paragraph that we have here, already approved by our attorney. Okay.
Okay. I think we're at the end and we're ready for some Q&A. How's the chat been, Grace?
Pretty quiet, but yes, I've tried answering as much as I can.
Do we have any
out in the field?
Let's see. Yeah, do we have any questions? Anybody curious about any of this for either myself or Rachelle?
let's see, competitive, I think Sylvia had a question. I may be out of touch with the market, but what percentage of competitive offers are there in King County? Well over half, Sylvia. Over 50% are in multiple offer situations. We just have a lack of inventory. A lot of times you can look at the inventory, and that is pretty close to what so you could go into market stats, isolate the data in that way in King County, and you're going to see that there's less than a month of supply. When you see the supply less than a month, you're most likely going to have multiple offers. So that's kind of an indicator. Not always the case, depending on the property and days on market, but that's a pretty good indication you're going to be up against multiple offers. You also, in January, you're not going to have the ability to go into a property and see, because business cards are not going to be required as of January. The rules changed. It will be a seller's choice, and it will be in the agent remarks on whether to leave a business card, where the sellers require that, but it is not going to be a Northwest MLS requirement to leave a business card. So I used to go into houses and I'm like, oh, there's like 50 cards. There's definitely going to be multiple offers. You won't have that indicator. And I would say there are people starting to pull off of showing time a little bit. So sometimes you can make it, and I guess you can be clued in if you're gonna have multiple offers. If the showing time obviously is filled in, you're gonna have a lot of showings, but there's really not a good way of, an indicator. I would go more with the market trends or the statistics in determining if you're gonna be in a multiple offer situation, and obviously relying on the listing agent to give you an indication of how competitive it really will be.
Mhm.
Let's see here. Christina, why go 75,000 when the limit is 5% of the purchase price at risk for earnest money? Can you give me a little bit more?
Yeah, you gave an example of doing more earnest money, bumping up from 50,000 to 75,000. But it's my understanding that the limit for
Good
what
point.
you could actually risk is 5%. So why would you go up to 75,000 if it's not something that they can actually access?
Good point. Yeah. Again, I'm in the moment. So Christina, thank you for reminding me of that. We have the limit of 50 of the 5%. So
Okay.
that doesn't benefit at all. That was just a bad example. So
Oh no, I don't think it was a bad example, because I think it's an example a lot of people use, and I've heard other experienced agents say, well, just put down more earnest money without that context. So I was wondering if there actually was a strategy that I just wasn't aware of that it might do. Okay, thank you.
So you probably want to do something different than earnest money on that case, and you may want to, cut timelines down or something like that. But that's just a misunderstanding of the earnest money provision in the contract. So good catch on that. Non-refundable. So yeah, there's a lot of discussion around non-refundable earnest money, and when you get that, you get the the email or the I'm sorry you didn't win, or you get the loser email or the loser phone call from the listing agent. A lot of times the listing agent is really confident and cocky about, oh well, the other offer was a non-refundable earnest money. And it's kind of frustrating, because your clients, again, you have to kind of go back to the drawing board and help your clients understand how comfortable they are with risk. And in order to get them on board, you almost have to go back to the table and basically educate them. Maybe you even pull out the earnest money non-refundable clause that kind of illustrates how that's done, how they can use that as a tool. I don't know, Shannon, if you had a question specifically about non-refundable, or if we need to cover that a little bit better. Can you, Nancy, can you go over the 2-1 buy down a little bit as that's a strategy and how you would communicate that? I had a direct message from somebody about the 2-1 buy down. And is that a strategy you're seeing to win in a multiple offer situation?
I mean, depending on, the 2-1 buy down for the financing side of it is for ease of payment for the client. So the type of financing that the client is getting, that's not going to really affect if they're buying down their rate. However, if there's a certain amount of seller credits that, they state they're contributing to, I think helping your client understand, well, we can utilize this in this way to cover your closing costs, or in this way to possibly do a 2-1 buy down and lower your interest rate. You still are qualifying on the fully qualified index rate. It just gives the ease of payment for that first 2 years. So again, it's if you're strategically looking at what that seller is willing to contribute, that can help your buyer, feel more confident upon maybe, okay, they can use some additional funds towards their down payment or towards their earnest money, things like that. So again, so it would just be strategizing, and before you make the offer.
Yeah, and I think it's communication, keeping it simple. Some of these listing agents don't understand 2-1 buy downs. They don't understand how, and if you get multiple offers, if you're writing language in or you're asking for closing costs, it's kind of a good point. Again, that is not as strong, or it could not look as strong if, say, to another person that's putting cash and it's just cashing out with no complications, or wrapping things in and closing cost contributions paid for by the seller. It does weaken your offer. So you want to kind of keep it simple in some cases, and maybe leave that part out. Again, you have to kind of really assess the situation based on who you're competing with.
Absolutely. And if the seller's giving concessions, I mean, that's just money that they're giving to the buyer, and how you utilize that doesn't really affect the seller, right? So if you're utilizing that, again, we'll give you more money for a down payment, or might, allow you to put more money down for the earnest money. So if you use it for a buy down, great. The seller's not going to care what your payment is 2 years from now.
Yeah, they don't care. They just want to know they're not.
Strategizing is key.
Right. A common question, Nancy and Grace, that we get is, what are closing costs typically? What kind of range can we give these people?
I would say a rule of thumb, you're looking probably, I would say 1.5% of the purchase price. Depends on the property taxes. We like to do a closing cost estimate. So if we have a property, pretty much is standard, right? Depending, you've got third party resources that you can check for. And so, that's your title and escrow closer. You've got reserves that you're always going to need for your property taxes. And then you've got just some, general fees like appraisal and credit report and that. So, I mean, I say 1.5%. I always like to quote high, and then come in lower, because I don't want to say, hey, your closing costs are $1,000, and then you get your loan estimate and, it's $5,000. So let's be real. A lot of times you'll get teaser estimates or things like that where it's really not real, and you need to know real numbers when you're going in with these offers.
Okay. So I guess our consultation you can download from our website, I think it says on closing costs, on the cost, I think we quote like your closing costs can be anywhere from 1% to 3%. So that definitely lines up, Nancy, with your suggestion there. And at what point can you lock the rate? That's another broker.
Yeah, you cannot lock the rate until you have a property identified, right? Because you're guaranteeing the funds based on that. If you want to gamble with your money, that's up to you. Once you get into contract and looking at, your closing date, we want to lock in the rate. I like to do that. I give my clients options. It's not my rate. It's not my loan. It's yours. But locking in and having that, because rates do fluctuate on a daily basis. And if there's a swing in the market in a direction that's not favorable, that could jeopardize you qualifying.
Yeah.
We do offer, because it is, a volatile rate environment, the option to renegotiate your rate if you're within, Grace, is it 5 to 10 days outside of closing? Should we see a steep decline in rates and it's, beneficial for the client, we can look at renegotiating that. So it has to be a pretty substantial rate drop, but we want what's in your best interest for you, the client, because you're going to be part of the movement family, because we service your loan. So
great. I think that's all the questions we got. I thought that was great. If you have any other specific questions, Nancy and Grace are happy to take your call outside of this. But hopefully that gave you some context and some scenarios of how to navigate the forms, as well as the communication that goes along with the lender when you're writing these deals. Have a great day.
thanks, everybody.